In just the past month alone, the S&P 500 is now down over 4.5%, and so there's plenty of dividend stocks trading close to their 52-week low. Now, just because a stock is at a 52-week low doesn't mean that the company is cheap. We have to remember that for every stock transaction where there is a buyer, that also means there is a seller. Now, with that being said, this can be a pretty good place to start looking for stocks trading at a good value. So in this video, let's go ahead and look at 5 different stocks trading close to a 52-week low. And one of these companies is actually a company I've been adding shares of to my personal portfolio. So let's go ahead and jump into it. And the very first one we're going to look at is going to be United Parcel Service, UPS, trading at $125.44 per share. Now we can see around 1 year ago, this company was trading as high as around $182 per share, but over the past year, down over 31%, and year to date, now down over 20%. Now, if we look at the dividend metrics for this company, we'll jump over to my spreadsheet, come up here and plug in UPS and hit enter. You can see all this data will automatically load in. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, for UPS, we can see this company now has a very high starting dividend yield, sitting at 5.19%. So you could potentially get some pretty big dividend payments from this company. If we look at the 10-year dividend CAGR, 9.3%. The 5-year dividend CAGR, now a little over 11%. So we can see in 2013, they're paying out about $2.48 per share, and in 2023, it jumped all the way up to $6.48. But what we can see is the most recent dividend hike was pretty small. It bumped it up to about $6.52. Now, why was this most recent dividend hike so small? Well, what we'll notice is if we look at the payout ratio, it's sitting at about 80%, and if we look at the free cash flow payout ratio, it's sitting at about 105%. Now, if you know anything about dividends, you know dividends are not free money. Dividends are paid out of a company's free cash flow. So if the dividend payments are larger than the free cash flow the company is generating, that's not sustainable long term. Look at this. In 2023, dividends paid out for UPS was sitting at a little over $5.3 billion, while the free cash flow that they generated was just a little over $5 billion. That's not a good sign. That's not something I like to see. Now, the previous years actually looked really good. We can see 2021 free cash flow over $10.8 billion. 2022 free cash flow was about $9.3 billion, and in those years we can see the free cash flow payout ratio was nice and low, and it was in a very healthy range. So yes, that dividend yield is attractive, but we have to keep an eye on these payout ratios. Now, that being said, UPS can fix this problem, and they talk about it a little bit in their investors presentation. If we jump over to this, first off, we can see 2024 guidance. What we'll see is revenue isn't really projected to grow at a high rate. We can see for the first half of 2024, their guidance was expected to be down by about 1 to 2% year over year, and in the second half, up by about 4 to 8% year over year. So revenue growth isn't really high, but where they do see one of their opportunities is if we jump over to the 47th slide, it's in expanding their adjusted operating margin. In 2023, this was sitting at about 9%, but they're hoping by 2026 this can get up to 12%, and this would be a nice boost to the bottom line for the company. And the way they expect to do this is what they're calling the network of the future, and what they're hoping to solve for is creating capacity through productivity with a lower cost per package, enhancing a highly productive network with less dependency on labor, and building additional flexibility to better serve our customers. So for example, if we scroll down, we can say they have automation and consolidation projects going on in places like Massachusetts. We can also see this in Texas. We can see this in New York as well, and they actually have 63 sites with major automation projects expected to be finished by the end of 2028. So this is around a $9 billion investment, so this is a pretty big deal. If we look at their free cash flow target growth, they're hoping that by 2026, this will be around $7 billion, and they're hoping they'll have a 3-year free cash flow CAGR of about 10.5%. Now, if they hit this goal, then we don't really have to worry about the dividend being safe. We can feel pretty confident that they'll continue hiking those dividend payments and making those big dividend payments if they can grow their free cash flow at the rate that they're talking about right here. And then finally, if we slide down to the 78th slide, it's one of my favorite things to look at when I'm analyzing an investor's presentation, and that's the capital allocation policy for the company. This is what management tells us, and it helps us better understand how the company plans to grow and how we can be rewarded as shareholders. So we can see the first priority for the company is reinvest back into the business. This is typically one of the most high priority things for pretty much any business that we'll look at, with the exception of a few companies. And the reason is, when you reinvest back into the business, you can grow more free cash flow in the following years and turn doing things like buy back shares and paying out dividends. So if you want to see dividend growth, you need to buy companies that are reinvesting back into the business. Now, the second priority we can see is a stable and growing dividend. They have a targeted payout ratio of around 50% of prior year adjusted earnings per share. So obviously they have some work to do to make that happen. We can see the third priority is a strong balance sheet. They have a target capital structure of 2.5 times debt to EBITDA. And in fact, if we jump over to my balance sheet breakdown tab, let's come up here and plug in UPS. We can see at a quick glance, things look pretty decent. The current ratio seems healthy, sitting above 1 at about 1.10. The debt to assets ratio seems decent as well. And if we jump back over to that investor's presentation, we can see their target capital structure. They want around 2.5 times debt to EBITDA, and we can actually easily check that. If we come down here, let's just use the ticker data function to go ahead and pull this in. We want to see UPS, and what we want to see is going to be their net debt to EBITDA. And we want to see it for the prior year, which is 2023, so I'll hit enter. And it looks like as of right now, this is sitting at about 1.88, so they're in a decent position. And then finally, their last priority is share repurchases. They want to use excess cash to repurchase shares. And we can actually get an idea whether or not they've been doing some of these things by jumping over to my stock screener sheet. We'll come up here and plug in UPS. And all this data will load in. Now, like we saw, share repurchases is one of the lower priority focuses for this company. And we can actually see this is true by looking at the past decade. Yes, they have bought back some shares, going from about 940 million in 2013 to around 859 million in 2023, but this is clearly not the highest priority for the company. We can see debt to assets has remained in a pretty healthy range, sitting close to around 30 to 40% for the majority of time. Then revenue per share has been growing, that's a good sign. Free cash flow per share, a little bit choppy. I personally prefer to invest in businesses with a little more predictability and stability than this, but yes, it has grown for the most part. Then earnings per share as well, been quite a bit higher in 2021 and 2022 and 2023. Now, if we look at this company purely from a valuation standpoint, we can see the free cash flow yield for this company sitting at about 4.71%. And keep in mind, free cash flow yield, this is simply the free cash flow per share divided by the company's price per share. It kind of lets you know how much free cash flow are you paying for. And then finally, if we look at them from a dividend discount model perspective, this values a company based on how much they pay out in dividends and how much that dividend is growing. Now we can see there was a couple decent dividend hikes in 2022 and 2023, but the most recent one was actually below 1%. Now, moving forward, how much they're able to grow their dividend depends on if they can meet their target free cash flow metrics. And like we saw, payout ratios right now are a little bit higher than we'd like to see. Even the company has stated this as well. But if they can meet their free cash flow target numbers, then we don't really have to be concerned about the dividend payouts. So assuming they can meet those metrics, let's assume a dividend growth rate of 3.75, discount rate of 8.5, and we come to a dividend discount model price per share of $142.41, which is about 13.5% higher than the current trading price. Our second company close to a 52-week low is a brand that everyone is familiar with, and that's the Walt Disney Company, stock ticker DIS. And the past decade for this company has been an absolute disaster. Look at this. Over the past 10 years, the company's down about 3.81%. Now, let's put this in perspective a little bit. If we go over to the charting tab here on Seeking Alpha, we're comparing it to the S&P 500. Now, over the past year, S&P 500 up about 15%, while Disney is down about 1%. If we zoom out 10 years, look at this. Disney down 3.72%, while the S&P 500 is up 166%. So again, this decade has been a disaster for the company. Now, Disney did just release their latest quarter's earnings, and the results were beats on the top and bottom line. We can see Q3 non-GAAP earnings per share of $1.39 was a beat by about 20 cents. So that's actually a pretty big beat. And then revenue came in at $23.16 billion, which was a beat by about $70 million, and it was up 3.7% year over year. So yes, this was a beat, but the year over year growth actually wasn't that much. Now, if we talk about streaming for a moment, what's going on with Disney Plus? Disney Plus hasn't been very profitable for a while now, but we can see they have seen some growth. Domestic Disney Plus subscribers was up by about 19%, while Hulu rose about 6% in Q3. Now, if we scroll down, we can see total Disney Plus subscribers right here. There really hasn't been a whole lot of growth since the beginning of 2023, and in fact, it's dropped just a little bit. They're currently sitting at about 153.8 million Disney Plus subscribers. Now, yes, that is a big number, but again, the growth just really hasn't been there over the past couple of years when it comes to Disney Plus subscribers. Now, if we take a quick glance at the earnings result broken out by segment, we can get a little bit more into the insights of the actual company. Where is the revenue coming from and where is it growing? First off, we can see Entertainment right here, we're looking at it for quarter ended and we can see it compared to last year. Overall for entertainment, it was up by about 4% compared to last year. If we look at sports, up by about 5% compared to last year. Experiences up about 2% compared to last year. And total revenue as a whole was up by about 4%. So in reality, yes, it's growing, but that's not very high growth. Now a few more key insights. Again, we already touched on the Disney Plus, but we can see Disney Plus core subscribers up by about 1% year over year to 118.3 million. But then we can also see average monthly revenue per paid Disney Plus core subscriber fell by about 1% year over year. Now we can attribute the poor performance to Disney to multiple things. They've had CEO change, they've had too much focus on politics. Some people claim that a lot of their content now is just really not nearly as good as it used to be. But really all those reasons could be reflected in the fundamentals. First off, we will glance at the dividends. Now, Disney did recently bring back their dividend payment that they had cut during 2020. And we have to keep in mind this is a semi-annual dividend payment, meaning they paid out twice per year. And as of right now, this puts the yield at only about 0.87%, and we can see right now, the dividend payout about 75 cents per share, not even close to where it was before they cut that dividend payment. Now, the free cash flow was easily covering those dividend payments before the dividend cut, with the exception of 2019, but we can see free cash flow has been so low over the past few years. It's a good thing they weren't paying those dividends because it would have been difficult to do so. Now, if we jump over to the stock screener for Disney, we can get quite a bit more insights. And when this data loads in, we can immediately see some pretty alarming things. So first off, revenue on a per share basis has seen growth over the past decade, going from about $25.13 per share to in 2023 about $48.63. So it has been growing, but look at the bottom lines, look at earnings per share. 2020 was a disaster, negative earnings per share, and since then has not come anywhere close to recovering to where it was pre-2020. Before 2020, earnings per share was sitting at about $6.68 per share. So the past few years have been pretty difficult for this company, and the same is true with free cash flow per share. Now we're starting to see a little bit of a recovery. 2023, finally the highest year they've had since 2018 at $2.68. We can also see they've actually been issuing new shares starting out in 2018. And then perhaps one of the most troubling metrics for me is the return on invested capital for this company. Again, ROIC, this is a measure of how profitable are the projects that the company is investing into. So obviously we want to see a high number because if they're investing into profitable projects, this will in turn eventually find its way to the bottom line. And in 2021, return on invested capital was about 3.2%, 2022, 3.24%, and 2023, 1.65%. Now, yes, we can make arguments this is because of Disney Plus, and maybe some of those investments are more geared to the long term, and some of those things are probably true. But overall, it's difficult for me to look at something like this and then come to the conclusion this is a good buying opportunity. Now, obviously, the focus for Disney is not paying out a dividend, so using the dividend discount model probably doesn't make a lot of sense in this scenario. So let's go ahead and zoom in and use Graham's valuation. We'll zoom in just a little bit closer, actually. Now, the first thing we need is our estimated earnings per share average, and I want to know what the average estimate is from analysts. So what I'll do is I'll just use the ticker data function to automatically bring this in. We'll come over here and click on Disney stock. We want estimated earnings per share average, and we want this for 2024. And when I hit enter, we can see the average estimate is sitting at about 4.77. So I'll go ahead and plug that in. I've already plugged in my growth rate projection, which honestly could be a little bit generous. It might be a little bit on the higher end. But after applying all these other metrics into Graham's valuations formula, we come to an intrinsic value of $81.98. Keep in mind, this was a company where if we look 5 years ago, at a certain time, they were trading as high as close to $195 per share. So it'll be interesting to see what happens to this company moving forward. The third company we're going to look at is Nike. This is the one I've been talking about a little bit over the past few months. It's currently trading at $74.04 per share, and over the past year, it's down 33%. Now, if we look at this company purely from a dividend standpoint, I've already plugged it in KE. We can see the starting dividend yield is sitting at about 2%. The payout ratios look healthy, really nice history of dividend increases, and double-digit dividend growth over the past 5 and 10 years. So from that standpoint, things actually look pretty good. We can see free cash flow has been covering those dividend payments every single year with the exception of 2020, and the payout ratio from a free cash flow standpoint over the past couple of years, both have been around 41%. So that's a pretty healthy range and leaves plenty of free cash flow left over to reinvest back into the business. So we have to ask ourselves, what's going on? Why is this company down so much over the past year? Now, keep in mind, historically speaking, Nike pretty much has the strongest brand in the world when it comes to footwear. Look at worldwide footwear sales of selected sports brands in 2022. Nike is by far the leader. It's larger than the second and third combined. And also keep in mind, the global sportswear market as a whole is projected to have pretty decent growth over the next decade, projected to be at about 7%. So again, what's up with this decline? Why are they not expected to benefit from this huge growth? And a lot of this large decline, as we can see right here, came from the company's most recent earnings report. If we click on earnings here on Seeking Alpha, we can see the latest quarter's earnings. They actually saw a beat on earnings per share, but they saw a miss on revenue. So mixed results again. Why did they get such a huge sell-off? Well, a lot of it came from a little bit of a surprise when it comes to revenue. If we look at the most recent earnings report, we can see full year revenues were $51.4 billion compared to $51.2 billion to the prior year, which was only up by about 1% on a currency neutral basis. Now, here's why this is a little bit concerning. If we jump over to our profitability income statement sheet, we've already plugged in Nike. We can see when we look at the revenue versus cost of revenue, this is a company that's used to having pretty solid and consistent revenue growth every single year, with the exception of 2020, of course. For example, in 2022, revenue was about $46.7 billion, while in 2023, it was sitting at about $51.2 billion. They had a 5-year revenue CAGR of 7% and a 10-year revenue CAGR of 7%. So to get news that revenue was only growing about 1% on a currency neutral basis is not a good sign. And to make things even worse, in the most recent earnings call, we can see they stated that now turning to our first quarter, we expect first quarter revenue to be down approximately 10%, and that was a huge shock to investors and probably sparked the huge sell-off of this stock. If we jump over to our stock screener page, let's come up here and plug in NKE, and the data will load in. Again, we've already touched on revenue. This has been growing historically, but it's not looking good moving forward for the next year or so. Earnings per share has been growing, same with free cash flow per share. We can see they've been buying back shares. Now, the debt to assets ratio has climbed quite a bit since 2020, so it's not in an unhealthy range, but this is something to be aware of. And historically speaking, return on invested capital has actually been very good, close to around 20% for the majority of the past decade. We can see 2023 a little bit lower than it typically was, but still pretty good at about 15.81%. Now, from a dividend discount model perspective, if we assume a dividend growth rate of 6.75% and a discount rate of 8.5%, we come to a dividend discount model price per share of about $90.28, meaning it looks a little bit undervalued from a dividend discount model perspective. The fourth stock at a 52-week low is a company that is an international stock, and I'm hoping to cover more of these types of companies in the near future, but that is Louis Vuitton. This is a company I own in my personal portfolio, stock ticker LVMHF, trading at $695 per share. Now, over the past year, they're down by about 23.13%, and year to date, down about 14.6%. Now, if you aren't familiar with this company, they mainly sell luxury goods, and they have a huge presence across the entire world. If we look at their balanced geographic revenue mix, we can see about 25% comes from the United States. We can see Asia markets about 30%, Europe around 16%. France alone is sitting at about 8%, and that's where the company is founded. Then we have Japan at about 9%. So again, this company has a huge global presence. Now, one of the most interesting things about this company right now is the amount of insider purchasing going on. Insiders seem to have a lot of confidence in this company moving forward. Look at all the insider purchases over the past year. There have been quite a few, and if we look at the past month alone, we can see multiple insider purchases, and I actually added 1 or 2 shares in the past couple of months alone to my portfolio. Now, if we look at this company from a dividend perspective, LVMHF, we can see as of right now, the company has a starting dividend yield sitting at about 2% and a decent history of increasing those dividend payments. Now, something you have to understand about this company is they pay a semi-annual dividend. They pay it out twice a year, and the amount they pay out in dividends fluctuates. Those semi-annual payments aren't the same amount, so that's something else you need to understand. Also keep in mind the tax consequences of this company's dividend payments will likely differ a little bit than your other positions depending on where you live, because again, this is a company based out of France. Now, the other last thing I want to mention, since it is based out of France, is your broker might not allow you to buy it, and I've personally started using Interactive Brokers lately. I like it a lot. I have a link to them down in the description, so check them out. You can buy Louis Vuitton there if you're interested in doing so. Now, moving back to the dividend metrics, what we can see is the dividend has been easily covered by their free cash flow. The dividend's grown at a high rate, 5-year dividend CAGR of 15%, so really rapid dividend growth, and we can see a 10-year free cash flow CAGR of 13.5 and a 5-year of 12.43. So I really like what I see from the free cash flow versus dividends paid out chart here. Free cash flow every single year is consistently and easily covering those dividend payments. Now, the free cash flow payout ratio in 2023 climbed up to the highest it's actually ever been. Not necessarily something good, but I'm not super concerned about it. I think free cash flow will continue to grow higher over time. If we jump over to our stock screener, we'll plug in LVMHF. Over the past decade, the company has consistently grown revenue per share, free cash flow per share, and earnings per share. This is a great sign. We can see shares outstanding have remained pretty steady, debt to assets in a healthy range, and return on invested capital has consistently been very good for this company, with the exception of 2020 when it's about 8.74%, which still isn't the worst thing in the world. We can see 2023, it was close to around 20%, which is really, really good. Now, something else I have to point out about this company is it's rare to find a company selling goods like Louis Vuitton with such high profit margins. We can see their 10-year average gross profit ratio sitting at 66.23%, and in 2023, it was sitting at 68.8%. The company sells luxury goods, and therefore they have luxury gross profit margins. From a dividend perspective, assuming a dividend growth rate of 7% moving forward and a discount rate of 8.5%, we actually come to a dividend discount model price per share of $999. And then finally, we have Occidental Petroleum Corporation, stock ticker OXY, trading at $58.87. And as we speak, the stock is actually up about 5% on the day, but in the past year alone, down by about 7.9%. Now, this is a company that operates in the energy sector, and it's actually a company that Warren Buffett owns in his personal portfolio. If we come down right here, we can see as of right now, makes up about 4.86% of his personal portfolio. And they just recently released their latest quarter's earnings. We can see Q2 non-GAAP earnings per share came in at about $1.03, which was a beat by about 26 cents. So probably has something to do with why the stock is up today. Now, something you have to understand about these energy companies is you can do very well with these companies when you buy in at the right price, but they can be very, very cyclical. For example, look at the earnings per share, how it's fluctuated up and down over the past decade. Definitely not much stability there. Same is true with free cash flow per share and revenue per share even. We can see shares outstanding has increased a little bit over the past few years. Debt to assets, it's in a decent range, nothing to be concerned about, but it has climbed a bit over the past decade. And then return on invested capital also jumps up and down quite a bit. So it's just very hard to predict what the future will look like for these types of companies. If we look at the profitability and income statement sheet, again, we can see revenue goes up and down quite a bit. Same is true with gross profit margin. So again, this doesn't mean that you can't make money with these types of companies, but for me as a long-term investor, I prefer to keep my strategy a little more simple. Now, if we look at them from a dividend perspective, we'll do OXY, and we can see they have a starting yield right now sitting close to about 1.5%. Now, something else we have to point out is during 2020, they did cut/suspend that dividend payment or decrease it, whatever you want to call it, but clearly the dividend payment quite a bit lower than it was prior to 2020. Now, that being said, there's obviously more potential for dividend growth moving forward. They're generating much more free cash flow as of right now and paying out less in dividends, so there's a lot more opportunity for them to grow those dividend payments moving forward. So if we look at the dividend discount model, we can safely assume a dividend growth rate of about 7% moving forward. Now, obviously, there'll be years with high dividend growth rates and low dividend growth rates, but that might be close to the average. So with a discount rate of 8.5%, we'd come to a dividend discount model price per share of about $62.77. But there you go, those are 5 dividend stocks currently trading very close to their 52-week low. Go ahead and let me know what you think of these companies in the comments down below. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.